Hello, everyone. My name is Varun Venkatraman, and I'm a senior analyst at CFRA Research in London. I'm here to talk about the UK home building sector, following a thematic research piece I published with the same title, which is UK Home Builders. If you build it, they will come. I'll start with our disclaimer on the next page. It's our standard disclaimer. Before we go ahead, please have a quick look. Okay, now moving on to the overview. In this presentation, I'm going to talk about what is happening in the UK housing market at present, what I think happens next, and what that means for specific companies we research. So what's happening in the housing market? I'll look at price trends, regional trends, types of dwellings, and the imbalances between demand and supply. Next, I'll go through why I think the surge in demand is likely to continue for longer. I'll do that by looking at employment trends, wage growth, mortgage rates, willingness of lenders to loan money, and affordability. And finally, I'll cover the four main home builders we follow, our forecast for their growth, profitability, and how that ties into valuation. So I'll start with what's happening in the housing market in the next slide. So through the COVID-19 pandemic, prices rose sharply, about 13% in the last 12 months alone. Now, this is no different to what we've seen in most geographies in the Northern Hemisphere. And the reasons are largely the same. The shift to work from home means people wanted bigger, better houses. Interest rate cuts meant mortgages were cheaper, and extended periods of lockdowns just meant people were stuck at home, and all of a sudden your home was your world, so people wanted to upgrade to nicer houses. But this rise in price is not uniform, and this is where we think the UK differs from what we've seen in some other markets like the US. Looking at the chart in the middle, in the last 12 months, London is up about 6% in prices, while the Midlands and Northern areas are up about 10 to 20%. Now, this is a really sharp contrast to the trend we'd seen in prior years, where London and the surrounding areas consistently grew and most of the north was flat. So what drove this? Again, two factors. One was Brexit and the other was lockdowns. Now, London has always been in demand for those in the professional services sector, which the UK is hugely reliant on if you think about financial services, banking, insurance, lawyers, and so on. Since all these professionals could work from home, they chose to stop buying expensive apartments in inner London and favored more rural areas, places where you actually have greenery and space around the house. On the other hand, Brexit and lockdowns meant most of the young transient workforce from Europe, as well as international students, were not lining up for London properties anymore. On the same note, foreign buyers, they drive a large part of demand. Investors from the Middle East, Eastern Europe, Asia, they just couldn't buy because they couldn't even visit the country during lockdowns. Now, if you look at the chart on the right, it shows you the effect on types of homes. You can see the red line, apartments, has really lagged the others, being types of houses. Lockdowns meant people wanted their homes with more spaces and just ran after apartments. So I've talked about areas that are in demand, the types of houses that are in demand. I'll come back to this a little later in the presentation with respect to specific builders and what it means for them. For now, I'll move on to the next slide, which talks about supply. The UK has had a structural shortage of homes, and we think this is the single most important factor that drives revenue growth over the long term for the UK builders. Now, this is not a recent issue, and it's been of concern since 2009. The 2017 study commissioned by the House of Lords found a shortage of a minimum of 1 million homes. Now, the study concluded that construction of about 300 to 330,000 homes per year was needed to catch up with the shortage. That works out to be about 75,000 homes a quarter. Looking at that chart on the right, you can see that consistently since 2017, not once have constructions caught up with the required level of 75,000 homes a quarter. Every quarter, the output's been far below that. One of the reasons for the shortage is the aftermath of the 2009 financial crisis. Many developers went out of business, credit tightened up, lenders were traumatized during the crash, and even equity markets were turned off the whole sector. They just wouldn't go near it. We'll see the sentiment again when it comes to valuation a little later in this presentation, but the key takeaway here is that there's a structural shortage of homes, and the current supply is nowhere near catching up with it. So going on to the next slide on demand drivers. Now, let's look at what I think will continue supporting demand. unemployment rates increased initially during the pandemic, but government furlough programs and leniency in the debt markets meant unemployment is much lower than what I think most people would have imagined going into this crisis. Right now, it's at about 4.5%, barely higher than the previous low of about 3.8%. For contrast, you can see where it was in the aftermath of the 2009 crisis at about 8%. But the way to think about this is ultimately more people in jobs translates to more people that can buy houses. So we think demand's set to continue for longer. And looking to the right, average wage growth. Average weekly wages are up about 9% in absolute terms over the past 12 months. So in the last 12 months, average house prices are up about 12%, but average wages are up about 9%. So sure, they're lagging a bit, but we don't think that's hugely impacted affordability. And I'll come back to affordability again as well a little later in this presentation, but let's look at mortgage rates on the next chart. So having a job with increasing income isn't enough, right? Buyers are still going to need mortgages, and they have plenty to choose from. On the chart on the left, I've looked at two of the most popular products in the UK mortgage market, the 2-year and the 5-year fixed rate mortgage rates. So for our international viewers today, know that the UK does not have many long duration products, unlike North America, where 10, 20, or even 30-year fixed rate mortgages are more popular. Typically, buyers in the UK fix their rate for 2 to 5 years and then refinance at a new rate and keep rolling it along. And you can see in response to the pandemic, lenders quickly raised their rates, and they peaked in about August 2020, at the end of the second quarter of 2020, basically. And at the same time, they also panicked and cut their lending. And you can see that on the chart on the right, the little bar in the second quarter of 2020. And I think two things are noteworthy that at present, if you look at the chart on the left, mortgage rates are now lower than where they were before the pandemic. And if you look at the chart on the right, mortgage issuances are higher than previous peaks. Essentially, there's a lot of competition amongst banks and lenders, and they're really keen to lend to borrowers at the moment. Coming back to affordability on the next slide, I've talked about high prices in different areas, and I've talked about wage growth. So how does this tie into profitability? On this chart on the right, we look at the price to income ratio. That is, if you take the average house price in each area and divide that by the average income in each area, you get to a ratio. And as you can see across England, the average has barely changed. That's on the top line highlighted in green. In fact, it's gotten cheaper through 2020. Now, this data is compiled up to the end of 2020 by the Office of National Statistics, so it will change when 2021 data is out, but we don't think it's going to change a whole lot. Even more interestingly, when you look at the area that has been least affordable traditionally, which is London, highlighted in light brown further down the table, you can see affordability has actually improved over the last couple of years because house prices did not rise as much as wage growth. And we think this sets up a really interesting situation where home builders who focus on the London market are likely to see a strong sales rebound in the years ahead when buyers return. A lot of these buyers are going to be professionals who return back to work in London, international investors who can travel again, international students who return to study for higher education in the UK, and so on. So going on from that, I'll go on to the next slide and look at the 4 large home builders. So here at CFRA Research, I personally cover 4 large UK home builders that are Barratt Developments, Persimmon Place, Taylor Wimpey, and the Berkeley Group. Now, we think all of them are likely to benefit from the trend I've described previously, but for different reasons. Barratt is a mid-price developer. Their average home is about £300,000, a little ahead of the national average at 260,000, but they're one of the largest in terms of absolute volumes that they build each year, and this is across a wide geographic footprint across the whole country. So if you think about the chart I had earlier about price rises in areas outside of London, Barratt will stand to benefit from that, and larger volumes translating to better gross margins. Persimmon Place is a developer of choice for first home buyers. Their homes are often a good 10 to 20% cheaper than the national average. And Persimmon benefits from a lot of first home buyers who are entitled to various subsidies from the government to make housing more affordable, like they can access homes with a lower deposit, more relaxed lending standards, and so on. So really it's your entry home market for new buyers and first home buyers. And then Taylor Wimpey sits in between these other developers with exposures to all areas of the market, but it's typically had slightly lower margins than the others. And that's because they've produced less homes. But interestingly, in 2020, they carried out a rights issue to build up their land bank. They raised 510 million, and they used that to go about buying land. And we think what that's signaling is, in the years ahead, they're looking to increase their output. And with the home builders, as they increase their output, generally their gross margins improve. So we would not be surprised at all if in the periods ahead, Taylor Wimpey starts to report better profitability. And then lastly is Berkeley Group, the premium offering of this lot. They typically focus on London areas just outside of London and the Midlands, the more premium price points. Their build quality is usually higher, executive type homes, and that's reflected in their prices. Their average homes priced around £800,000 compared to the national average, which is around £260,000. And so with that, I'll go on to what our forecasts are on the next slide for these builders. Now, there's a lot of numbers going on the table on the left, and there are forecasts for our growth rates of prices on top and volumes below that. So just eyeballing these numbers, the key message here is that despite our bullishness on the sector, we're not extrapolating growth rates that go straight up. Firstly, because housing demand doesn't work that way. It takes quite some time for demand to work its way through the cycle. And there's quite a bit of lag between generally when people start looking at houses, securing financing, putting down a deposit, and the house being built and realized as a sale by the builder. And then secondly, we think it's likely that after that initial surge in late 2020 and first half of 2021, that demand may cool a little bit before it starts to grow again. So you could say we're being realistic in our expectations for demand growth and perhaps even a bit more on the conservative side. But despite this, we think the sector is attractive. And now using those forecasts on the tables on the left-hand side, you can see what that translates into gross margins for the periods ahead. You can see the changes up to the current period, the first half of calendar year 2021. And now for the periods ahead of that, we think Taylor, Wimpey, and Barratt will slightly improve, while Persimmon and Berkeley will stabilize from their current levels, and they should be all able to maintain that range of around 20 to 30%. And another way of thinking about this is how those margins then tie into valuations, and I'll go through that on the next slide. So tying in our forecast from the previous slide, the table on the top of this page, focus on what the forward price to earnings ratios look like based on our earnings estimate. In essence, we expect the builders to trade between 9 and 12 times their 2021 and 2022 earnings. Now, if you look at the chart below, those multiples are almost at the lower end of the historical average. And when you consider this in the context of the broader picture, as in the benchmark S&P Europe 350 index, that's trading about 20 times. So as an aggregate group, we think it's quite an attractive ratio that they're trading at, especially when you consider their return on equity and the dividend payout profiles. So in summary, despite the recent increases in home prices, we think demand will remain strong for several years ahead, and that's primarily driven by a substantial shortage of housing in the UK market. People are able to afford houses just as they were before the pandemic because of wage increases, cheaper mortgages, and more availability of homes. The 4 home builders we research are uniquely positioned to profit from these trends due to their differing exposures in geographic areas, price points, and specific competitive advantages. And lastly, we think valuations remain attractive on the shares of these businesses. So with that, that draws an end to the short presentation. Thank you all for having taken the time to listen to me today. If you're interested in further information, please look up my thematic research piece with the same title on the Market Scope Advisor platform. And if you're interested in other research material from CFRA, please don't hesitate to contact myself or other members of our team via the website.